This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes. G'day and welcome to another episode of Wealth and Toil. My name is Dylan Pargiter-Green. I'm Director and Advisor at Bold Wealth. I'm here with Luke, Laretive, the man, the myth, the legend of investments, and specifically small cap investments is what I hear based on today's podcast episode. Mate, how are you?
Good, mate. How are you?
I'm good. Just,
Can I start the episode with an apology? I will apologise to the Wealth and Toil, all 7 of the Wealth and Toil subscribers who wait with bated breath every week for their episodes. I think we've been on a 2-week post-holiday hiatus as a result of essentially catching up. And I went to Perth for the week, which we're going to talk about. We'll do the Pilbara thing. And then last week, you and I got together on some actual work stuff. But we didn't actually get to do the episode, the free stuff that we give away every week.
We booked in a time to do a podcast, and I apologise to everyone that in the last episode we actually said that we would do this very frequently and back to normal frequency. But look,
it hasn't been back to normal frequency.
Sometimes we do need to preference our clients and getting the work done for them.
Particularly when it's my mother's financial planning, which was, it is important to me, because if you don't do it, then I've got to do it, and that's going to piss me right off. So
Bold Wealth's number one. Bold Wealth's number one client.
She is.
Mrs. Laretive. Lovely to have you listening today, Janelle, which I'm sure you do every week.
Real estate agent.
Anyway, mate, things are good. Market's been up. Market's been good. We're all happy. Clients are happy. I think today we're going to talk.
That's one thing I can guarantee you that.
Well, speak for yourself. What we're going to do is talk about your recent trip to WA, but specifically the trip to the Pilbara and some of the companies you went and saw and some of the opportunities. And we're also going to run through the small cap fund, talk about some lessons in running that over the first year, the things you did well, the things that you, look forward to implementing over the next year, and why you're quoting yourself as a top quartile manager on Livewire.
We are a top quartile manager. That's an objectively provable number. But yeah, look, the small cap fund's been going for 12 months now. And yeah, we're really pleased to spit out some good numbers. I think I know it's done 28.4% return. That's 9.6% ahead of benchmark. And right up there in the peer group. So very pleased. But yeah, look, I suppose that the key takeaways, I think, from the year are different sub-asset classes have different opportunities to generate alpha at different times. It's been a really hard period for our large cap strategy, and it's been a really hard period to be an ASX sort of 200 style benchmarked manager and investing in large caps, because you've just had money flows just driving everything, and it's not been sort of valuation or quality or growth or any of the normal sort of drivers of the market, and a lot of irrationality in my view. In the smaller end, no one's paying attention. Everyone's asleep at the wheel. No retail investors there. All the COVID people have left the market. No one's hunting deals. There's no IPOs. There's no placements, or very few. And as a result, there's lots of opportunity for people who are out there doing the work. So that's been the tale of the last 12 months. I kind of think that's going to continue. Small caps haven't even really caught up to where they should be in terms of relative valuation compared to, say, large caps. Now, that might be large caps coming down a lot and smalls not going up that much. It might be smalls going up a lot and large not changing very much. But regardless, I think that probably the next 12 months, next 24 months, realistically, is going to be the time where you want to be allocated more to smalls. So that was probably lesson one. I think lesson two as well is maybe what has happened isn't necessarily what's going to happen. And I think people get caught up in buying stocks, investing with managers, investing more broadly on things that are working, or having their process be, well, what's worked, I'm going to do that because that's what's worked. And whether it's ETFs, looking at the best performing ETFs and then allocating money that way, best performing fund managers, best performing stocks, or good performing, however you want to define it. I think that's really erroneous. I mean, momentum matters, and yes, things do trend, but I think last year was the perfect example of some of the best things we bought, some of the best opportunities we had were the things that everybody hated and no one wanted to go near.
It's such a common thing that we talk about with clients when we're talking about investment, I think, and like biases, but specifically recency bias and how easy it is to look at something that's done well previously, the last year's flavor of the year, and go, oh wow, they're really great for a lot of reasons.
Extrapolate,
yeah. Right? Very rarely does it work like that. I think we talked about this maybe 6 months ago, where we looked at managers that were in the top quartile for four quarters in a row. Then on average, it was some ridiculous number, like 80% of them don't make the following year.
Yeah, I think the key thing with manager selection and past performance, I think, is more to focus on, well, like one of the things that we focus on, I should just talk about what we actually do rather than sort of this in the abstract, is we look at rolling returns. So I think about our investment time horizon as one business cycle. So 5 to 7 years. Now, the business cycle is not an exact science, but that's typically how often they've gone. So I'm I've got a relatively long investment time horizon, and I'm thinking about making investments with managers who ideally I can hold for at least the business cycle. And I want to see them execute their strategy through the cycle because I think they can outperform on that basis. However, I think the people often, based on where we are in the cycle, different strategies are going to be working well or not well at different times. And so you can have a great manager who maybe has outperformed after 7 years, say, for example, a great manager who's outperformed in year 1, year 2, year 3, year 4, year 5, and then average performance in year 6, and then underperformed in year 7. And their since inception numbers will be negative, under benchmark. So probably, depending on the quantums. But the reality is they're still a good manager. Like, you should still be considering them. But their short-term numbers will look terrible. And when you look at their monthly performance fact sheet, 1 month will be negative under benchmark, 3 months probably be negative, maybe 6 months might be equal, 12 months might be under, 2 years might be flat, and 3 years might be positive. And you'll be like, oh, they're not doing very well, and Inception's now red. So you'd be like, oh, I'll just discount them. They're underperforming. It's like, no, they're actually not. They've actually outperformed a lot. And all you're talking about is that the current period has recently skewed their numbers down. And I mean, I can talk about that in my large cap strategy at the moment. You don't go from being smart for 3, 4, 5, 6, 7 years, and then all of a sudden you're dumb. Like, it doesn't, that's not how it works. So I think recency bias selecting managers is, and it's our industry's fault. It's the industry's fault for the way we present data. We present it
exactly
what 1, 3, 6, 12, 24, 36, 3 years, 5 years, 10 years data. And it's all pointing, the common thread between all of those things is it all points to today, what's happened to today. And in reality, it doesn't fucking matter what happens today. What happens over the next 10 years is what matters, right? So anyway, look, that's just, I think, something I'm trying to educate people with at the moment. And, it's great that we've done a big number in smalls this year. It's fantastic. I'm stoked. Don't get me wrong. And we're going to try and do it again and again and again. But I can tell you right now, you're not going to get 10% outperformance in large cap. It's just not possible. Top quartile manager there can do 1.5% outperformance over 10 years. Compound. Now, that's a materially large, more increased money, like increase in total money compounded. If you put, you guys can use the calculators, but go and put 7.5% and then go and put 9% through a compounding calculator for 10 years. It matters. Worth doing. But it's just not going to be. You're not going to, the average fucking top quartile manager in smalls over the last 5 years, when I did the numbers 6 or 12 months ago, was outperformed by 8%. You're just not going to have those kind of numbers in large caps. The opportunities
and I mean, there's a couple of things there as well. Like we've talked about previously, that the small caps index is inherently flawed. So, it is it is an alpha achievable index as a benchmark. But I often do this where I take my small caps managers and I compare them against the total ASX, like total market returns. And the reason that you do that is because you see the names that people want to buy and things, and it's also a more stable and generally has been a higher benchmark of performance over the long term.
Sure.
So if you're outperforming that, there is actual, I think, alpha in your manager selection there. Anyway, we're not down
over the last 12 months, they're much the same. So they're both about 18% over the last 12 months if you did the 200 or the small ords. Probably a better benchmark deal. And this is, again, fully nuanced, like detailed stuff that no one else is ever going to talk about. But so that the small ords is essentially stocks number or rank 101 through 300. That makes sense?
Yep.
What you should do is, if you're going to compare to, you say, okay, my manager uses the small ords as a benchmark, like I do. That's 101 through 300. If my next best alternative was to buy just large caps, I should just compare to the top 100. And we use that as that ratio of small ords to top 100. We use all the time as a measure of size. So we want to know where the fund flows are going and where people are allocating money. Is it just on the basis of size? And size over the last 12 months in large caps has been the best predictor of returns.
Yeah, wow.
Which just tells you just people allocating to index strategies and CBA getting more and more and more and more and more expensive for no good reason.
It's so interesting, isn't it? I mean, this is probably a topic for another day because we've
gone massively off topic, but that doesn't matter.
Massively off topic. But I don't see there being necessarily an end to that allocation. And I mean, I think the point of all this, and we can talk about that in another podcast, I think it'd be really interesting. But the point of all this is that accurately picking what you're trying to do from a performance point of view isn't always about comparing, the small ords benchmark and a small cap strategy. You need to make sure that you're achieving the returns that you're setting out to do and that's appropriate for what you're trying to get an outcome of.
And you've got the right allocation. You've got the right allocation to your risk profile. Just because smalls have done well last year doesn't mean you should allocate 97% of your portfolio to it tomorrow, right? Like, it's all about asset allocation. And at the end of the day, don't be upset in a year that you didn't allocate more to a high return part of the market, because that same lack of allocation you're going to be probably happy with in a year when the returns are much less volatile. We don't know when we're going to generate returns. I couldn't have told you what the returns were going to be last year. I can give you a hunch. I mean, and there's plenty of, me writing and talking and waffling on about how I thought.
Call it an educated guess, not a hunch.
Yeah. Like, I can tell you that, the valuation disparities at 5-year gap. But as you say, Dill, I can tell you till the cows come home that CBA was expensive on 20 times. Then it went to 21, 22, from 23 and a half times. It's the most, when it was the most expensive bank in the world, I was saying, and I mean, I wasn't the only one. Phil King, biggest hedge fund manager in the country from Regal, was on the front page of the AFR saying he's shorting CBA. It is now 30% more expensive than that. So, like, we don't know. We don't know. We're only guessing.
Yeah, educated guesses is what it's all about. But on that note, it's good to then maybe pivot to some things that you do know, and that's probably on the basis of your recent trip to the Pilbara, because you have some knowledge on some companies that you visited, and some of them might appear over the coming months into your fund. But I think this is an example of. It's an excellent example of doing things that not all managers do. And it's doing things that, I guess, have the ability to set you apart in your decision-making process. So
Well, I think the interesting
specifically,
thing is, the interesting thing to me about it is that, okay, we can go through the trip and that's fine, but it was more having, as you as a client, I was surprised that you guys don't get that sort of communication and transparency from other managers. So, I wrote up a little thing, put some photos in it. Some of my clients will, received it, and, Dill is one of my clients, and the guys at Bold also got it. And I was just shocked at how interested people were, because for me, it's just another mine site tour. We do that kind of stuff. It's what we do. But everyone's like, oh, wow, like that's great. So like, I'm interested. That was really the key learning for me, is I should be
good.
more about.
I'm glad. I mean, the key learnings for me were, fundamentals of those companies and whether or not they're worthwhile holding in portfolios. But I'm glad that you learned something from me as well, mate.
Always do.
I think on that note, right? Like one of the things we tell every manager we use, whether it's you guys, whether it's the passive guys, like whether it's some of the direct holdings we have, clear communication of what you're doing and in your strategy and where you're actively going to seek value. That is by far the most important thing for an advisor, because I'm allocating clients' money to areas that we believe that there is strength in the people who are then investing and building a strategy around that investment. And the more clear and concise and valuable information that I can get on a strategy, the more confidence that I end up having in people. And you know what? Like, we do get some really good updates from some fantastic managers. And I honestly believe that there is a correlation between those people that have strength in performance and have clear and quality communication to their advisors who are using them, because, that is an example of how dedicated you are to your process and dedicated people are to making sure that their good ideas, and in some cases their bad ideas, have been shared with the people that matter. And that's your clients, right? So, Pilbara was really interesting. You saw some really interesting companies there.
Yeah,
I thought.
So we did. I mean, we did a bit of a joint trip. So we went over on a Monday night, had the most important meeting of the trip, which was dinner with my mum, who's now a celebrity on the Wealth and Toil podcast, as you're hearing. But then on Tuesday we had a full day of meetings in Perth, and there was a few interesting ones. But we're doing a lot of work around the mining royalties space at the moment, and spending a lot of time looking at royalties. So we met up with a few companies to talk about that, including like the big ASX listed multi-billion-dollar one, which is Datura Royalties. DRR is the code for that. And so, among others, and a really interesting day, probably, beyond the scope of this particular podcast. But and then on Wednesday, went up to the Pilbara with Pilbara Minerals, code for that's PLS. They're probably the biggest, ASX listed spodumene miner. Spodumene is a mineral that's hosted in another rock called a pegmatite, and they crush it and do a bunch of stuff to it, and eventually it becomes lithium carbonate. And lithium carbonate is used in batteries or lithium hydroxide, depending on the process. Now, so we went and looked at their big pit, the ore sorters, and spent a day with management, and then niched off from there and went 47 k's down the road to an exploration company who were kind of trying to become Pilbara 2.0 in similar ground, called Wildcat Resources, code for that's WC8, the number 8. Spent the night with them, really good dinner, and sitting on the fake lawn, in the middle of the desert sort of thing. Is pretty cool. And with a bunch of other sort of analysts, fund managers and investors. There's probably 10 of us there. And then the next day went up to Pilbara Port Hedland. And had a look at the Utah port, which is where some of the smaller sort of non-BHP, Rio, Fortescue, the guys who don't have their own berth, do their exporting from. Spent some time on the ship loader, talking to the guys who manage the port maintenance, and getting a really good understanding of how an iron ore port works. I've never been to an iron ore port before. I spent plenty of time at a coal terminal, which is, up in Queensland, but yeah, never been to on an iron ore port tour before. And we're just talking about scale that is pretty hard to fathom unless you go and see it with your own eyes. And yeah, just interesting stuff like dust suppression, which probably no one really thinks about, but BHP have had to build essentially big walls. We were joking calling it the Great Wall of Port Hedland, but that wall is there essentially to stop from the prevailing winds the red dust from the iron ore blowing into Port Hedland and just covering everything in Port Hedland. Dust is like the biggest community issue in Port Hedland, right? So I'm like, these are whilst this isn't like, oh yeah, whacking the model type sort of, it's interesting to understand the context in which things happen. So we did that, then went back to Wildcat, walked over some rocks, sussed out what they're doing, interesting. But yeah, and got essentially like, had a really good day looking at, drill cores and walking over pegmatite hills and, chatting to geologists about stuff, which was pretty interesting. And then, yeah, flight home. So
a great day looking at rocks.
Yeah, a little bit. So, I think there's so many learnings. Me as a manager, as a business owner, like I took young Ben with me, and Ben had never been on a mine site before, and he'd never really spent any time outside of a boardroom kind of environment with, I suppose, mining people. And I think it was just invaluable for him, like I said, to create some context around the work that we do. We've got another couple of site visits organised early next year. So, we're trying to do more of this stuff, and it's something that, we think is pretty important, particularly the smaller end of the market. And, whilst going to see Pilbara was great and I really enjoyed it, I don't want anyone to take it the wrong way. We just get so much more out of spending a day with a company that's under 500 mil market cap like Wildcat, who, your, smaller group of people, better access. It's always going to be more niche, and probably interesting to a company of our size. So, that was the trip. And then another day in Perth on Friday. Again, probably spent the day meeting a bunch of sort of finance people, corporate advisors, people we get deal flow from. And
is that all at Little Creatures, or?
No, this was running around. So we did a bit of, we were here, there, and everywhere. I was in the Uber all day, but and somehow managed to find my way to Cottesloe in the afternoon to my favourite little Lido Italian restaurant down there at Cott.
Oh, nice.
So yeah, managed to sneak in 2 hours down there with a client who's a sort of who's a good mate of mine as well, and JB and Benny. So that we've still had a good time. Still managed to have a good time.
JB made his way over.
Yeah, Chairman was over on non-Seneca related business, and I somehow managed to see some expenses going through the Seneca Amex, so I might have to query those.
Don't. Yeah, I think there's a query that needs to be made there. Tell me.
That was a trip, mate. I suppose key takeaways from an investment perspective. Look, we think Wildcat's going to get taken over. If you want to read that thesis, we just wrote it up for our subscription research product, which is called Good Research. So I suggest you go and subscribe to a trial and read that. I think Pilbara Minerals getting $1 billion debt facility yesterday might indicate that I'm probably right there, but we'll see. I'll make a public prediction. I think it's going to be a 2/3 cash, 1/3 stock type deal to Pilbara, from Pilbara to Wildcat. I reckon 800 mil takeover. That's what I'm going to call it. It's current market cap 442. It'd be like a 90% premium if they want to get the deal done. And MinRes will do it if they get the mining services contract. So MinRes got a blocking stake there for 19.9. So and Chris needs the money anyway to pay down his debt at MinRes. So I think everyone win. It all happens, but there's a prediction. Let's see how we go.
Well, I look forward to seeing the next update on the small caps fund and Wildcat being in there, and then all of a sudden Pilbara being in there for a very short period of time.
Yeah, look, I don't know. I mean, I don't know if I mean, this is me just what they call it, like speculation, just baseless speculation or educated
pure speculation.
Yeah, pure speculation. But I think it makes a lot of sense, even if they don't do it now. Like you could do that in 6 months' time, but probably end up having to pay more for it. And if I was on the Pilbara BD team, that'd be the first thing I'd be looking at. wouldn't be running off to Brazil to buy another Latin resources like I did last time. Now, not that there's anything wrong with it, but there's one 50 k's down the road, probably even better. So, yeah, very interesting. Other than that, look, Perth property market's going ham.
Sure is.
The prices of, I'll just say, just shit property in the northern suburbs where I'm from Scarborough, Doubleview. The prices in Doubleview, what you're paying $1 million for there is out of control. Like anyone who's buying a house in Doubleview should think about moving, and they can probably move to South Yarra for cheaper. So it's like it's out of control. You could probably live in a tier 1 sub. Look, Mosman's looking affordable compared to Doubleview at the moment in Sydney. So I can't
keep in mind.
Still, I mean, I just can't see it lasting. I don't know about what your gut feel for it is.
Perth historically hasn't lasted as a property investment. We have had quite a lot of clients over the last sort of 12 to 18 months been buying in Perth and taking this ride, but the advice is generally that, and this is from their buyers agents who are buying over there, the advice is generally being that they're going to buy it, hold it for 4 to 5 years and then sell it, because Perth as a market does tend to have some cyclical elements to it. Look, that's perhaps unfortunate for people that live there permanently, who are trying to buy houses for the long term.
Living in your house, you like it, and dish is done. Like, I mean,
yeah. But what I would say is, if you are going to go into that market, definitely seek the advice around it, because it's not like a lot of other property markets in Australia, which you might be able to hold for 30 years and have really good success. There was a lot of people who were burnt coming out of coming into the GFC in Perth, and then when mining had a difficult time in the middle of the 2010s as well, you saw people with significant amounts of negative equity in Perth. That's obviously changed. If I had had my time again, I would have gone back 7 years and snapped up a whole bunch of those properties and probably would be absolutely laughing right now. But you just don't know. It tends to move with economic conditions a lot more than other cities, and that's because you've got population that is more transient.
Yeah, look, I mean, I don't know. I think Perth's a pretty good place to live, apart from the fact that it's so isolated, and as long as you're happy in Perth, you don't want to go anywhere else. It's pretty good. I do think that my gut feel, well, in my experience, just as a Perth resident and observer, and just chatting to people there, Perth seems to have like a bull run for 2 years and then flat market for 8. Like that's kind of how it works. The average returns on a 15-year adjusted basis are kind of the same as anywhere else. Just they have these bull run periods, and recency bias again can catch people unawares or a little bit ignorant of the likely reality. Look, who am I to say that Perth property prices don't go up 10% per annum for the next 10 years straight? I don't know, just like someone who can do basic maths. But like,
it's interesting. It's interesting to say that though, but like Perth is an example of a property market that has a 2-year boom and then an 8-year sort of flat line with perhaps a little bit of a drop off. That's actually a lot more common in property markets than people sort of see. You sort of see the total growth in property over time, but if you look at individual sectors, and like there's a really good example of this with Sydney. Now I don't know the exact dates, but I could potentially find out. We could put it in the show notes. But during the period, I think of around 2011, 2012 to 2017, 18, the Sydney market was actually quite flat. And post sort of GFC, there was a little bit of a rise because there was a bit of a dip all around the country. And then the Sydney market was really slow. And if you compare that to, say, over that same time period, what Victoria did, even to a degree what Brisbane did, you would look at it and you go, why would you ever buy property in Sydney? And then subsequently 2019, then you had COVID, you had migration, and then you had sort of seen pretty much all around the country, maybe barring Melbourne, you had this huge property boom, and it's extended now to places like regional Queensland, places like WA, which have a lower entry point for these properties, are probably going to see another 30-40% of growth, but nobody knows when that tap's going to turn off. I think that's where you need, if you are going to go into property, you need to have advice on it from an investment point of view.
Look, I mean, it's not my go.
It's not your wheelhouse, I know.
I just do what I do, and I seem to make a decent return doing that, so I don't need to do much else. But like
I just think look, property's a long-term asset. Every single person I've probably ever spoken to about property, I say, if you're going to buy a property, hold it for 30 years, and you'll be absolutely laughing. If you are trying to make a quick buck on property, whether it's through buying and selling after a boom, whether it's by knocking down and renovating, which I personally have done several financial plans on, and it is more often than not a terrible financial idea. Like unless you're going to build the house yourself, or
in which case the divorce will cost you more, so don't worry about it. It's not a good idea.
Like, it's
whatever returns you have, you should divide them by 2.
It's so unlikely. It costs you so much money in external things. Build costs go up. You have to rent. You have to do all it. Like, it's unbelievable, right? But property, from an investment point of view, like the people who have made the most property are the boomers, and it's not because property has been very good over that same period of time. But if they took the same amount of money that they had in the 1970s and 1980s and put that money into the market, the exact same amount that their money had, that their house cost, they would have more money now.
Yeah, the reality is that it's just the leverage, right? The reason why people feel good about it is because it's the leverage. And tax deductibility about it, and the, what I would call ridiculous policies around capital gains tax discounts, negative gearing, blah, 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 blah.
We like negative gearing. We like negative gearing because it allows people to invest in also other assets and claim the tax deductions as well.
I've got no issues with that, with negative gearing on other assets that don't require people's shelter. But we can talk about the politics of that another day, or you can go read the Livewire I wrote recently about all of this stuff. All right, Dill.
We've waffled. This has been a great episode. I really hope that everybody followed, because we've talked about some absolute roundabout garbage.
This has gone right,
absolute gems. Some gems in there. I don't know how we ended up talking about Perth property or property in general, mate. So
if there is any distinguishing characteristic of the Wealth and Toil podcast, it is a lack of agenda. That should be
Look, what is it? Market cycles, 5 to 7 years. 5 out of 7 episodes will be really well structured, and 2 you'll get like this.
I would suggest that it's the opposite of that, but we'll see how we go. Look, I think on that illustrious commentary, we should wrap, and before we bore somebody to death. But mate, look, glad to be back on Wealth and Toil Rhythm with you. Looking forward to doing another episode next week. Let's put it in the calendar before we forget.
Let's do it.
Appreciate everyone's patience with us. We're battlers at the best of times, and so we're trying to get these out, but it is difficult for us sometimes. And look, if you've got any questions about my Pilbara trip, Wildcat, lithium,
we'll chuck the article from Livewire in there.
Other stuff we're doing, feel free to reach out to me. I don't bite. And happy to have a chat, or ring them the mobile, or email me. And still appreciate your good work as always, my friend.
Lots of love, my man.
Have a good week.
You too. We'll see you soon.
Thanks, mate. Bye.
Bye.